In this video, we're going to start talking about the Greeks. What are the Greeks? Let's jump in and let's find out. So the Greeks are used to price options. So with stocks, for example, you can price a stock based on the present value of expected future cash flows, right? With options, because there is a set expiration date, there should be some sort of intrinsic value or extrinsic value to options pricing. So the Greeks are actually used to price options, not the actual stock. And there are 5 Greeks, which combined helps you price these options. So let's talk about the 5 at a high level. I'll show you where to find them on market data, and then we'll break down each one and what they mean. So we have delta, we have gamma, we have theta, we have vega. Even though vega isn't actually a Greek letter, it's still counted as one of the Greeks. And lastly, we have rho. So using these 5 Greeks, we can price options. So let's see where we could find these Greeks. Here we're looking at QQQ. You can see we have the column for delta, gamma, vega, theta, and rho. And you could just move them around however you'd like as well. Again, this is with E-Trade. And you could see each one of them has its own numbers. So here you could see delta, gamma, theta, vega, and rho. And using these numbers, that's how these bid asks are priced. Based on these inputs, the bid and ask is priced. I mean, huge asterisks right here. And there's something called the Black-Scholes model, which is what is used to actually price these options. But it's way above and beyond the scope of this class, and honestly, you don't really need it for what we're doing here, but just want to let you know these Greeks are here, and this is what is used to price the options. Great, now let's break down what each one of these Greeks represent and why it's beneficial to understand this. So let's start with delta. Delta measures the change in option price for each $1 increase in a stock's price. So let's go and look at the example. So here we're looking at delta. It's negative 0.25. That means if the stock increases by $1, this option price will decrease by 0.251. Now notice how the deltas are negative for put options and they are positive for call options. Because if the stock increases by $1, the call option has a higher chance of getting assigned. For example, the 288 strike price, if the stock increases from 276 to 277, this option, assuming all else equal, would increase by 33 cents. And that's what this delta measures. Again, biggest takeaway is deltas are positive for call options, they're negative for put options, and the delta measures how much an option's price is going to change for each $1 increase in the underlying. Next, we have gamma. Gamma is actually a derivative of delta. Gamma measures the change in delta for each $1 increase in the stock's price. All right, let's look at an example. Here we have gamma. What this means is we're looking at, let's say 270. How much is delta going to change for each $1 increase in the stock's price? So if the stock increases by $1, delta is going to increase by 0.014. Now notice here, gammas are lower the further it's out of money, and it's actually lower the deeper it's in the money. It's the highest at the money. Similarly here, gamma for call options, you'll notice it's the highest values right at the money. It's the lowest deep in the money and lowest out of the money. So it's the highest right in the middle. And again, gamma measures how much is delta going to change based on each $1 increase in the underlying. One more thing. So this is for July 15th expiration. Gamma is actually also the highest when it's very close to expiration as well. You'll notice gamma is almost 5 times higher at closer expirations than further expirations. So the further expirations at 0.014 gamma, closer expiration is at 0.05.